Most celebrated fund managers are not skilled. They are statistical inevitabilities. In a large enough pool of random performers, some will look brilliant by chance alone. We will test this with probability, academic evidence, and a simple rule for when to trust a track record. Here is a fact that many find hard to accept: in any large group, some people will appear extraordinarily successful purely by chance. Imagine 10,000 fund managers, each with a 50% chance of beating the market in any given year. This is not a model of skill, it is a model of pure randomness. Yet, even in this random world, we will find stars. Let's calculate the odds. If a manager has a 50% chance of beating the market each year, the probability of doing so 5 years in a row is 0.5 raised to the 5th power. That is 3.125%. Not zero, but small. Now, apply that to 10,000 managers. The expected number of managers with a 5-year streak is about 312. These are the ones who get media attention. The media and investors only see the 312 winners. The other 9,688 are ignored. This is survivorship bias. We focus on the survivors and forget the many who failed. The genius label is applied to those who were simply lucky. The same logic applies to any field, sports, business, and even science. This chart shows the expected number of managers with a 5-year winning streak out of 10,000, assuming pure luck. The bar on the left is the total pool of 10,000. The bar on the right is the 312 expected streak managers. This visualizes how a small probability can produce a noticeable number of apparent stars. Academics have tested this rigorously. Fama French analyzed 3,156 U.S. mutual funds from 1984 to 2006. Their conclusion: after fees, almost no fund produced statistically significant excess returns. The few that appeared to outperform could be explained by randomness. This is a direct challenge to the idea that skill is common. To understand why so many geniuses appear, we need the concept of the false discovery rate. Suppose the true proportion of skilled managers is very low, say 1%. Even if we test for skill with a 5% significance level, we will still find many false positives. The false discovery rate is the proportion of significant results that are actually false. In a field with many tests, this can be high. Even if a manager has genuine skill, it takes a long time to prove it statistically. Barras, Scaillet, and Wermers found that you need about 10 years of data to distinguish skill from luck at a 95% confidence level. Most fund managers do not survive that long. So, by the time you can be confident, the manager is often gone. Let's formalize the 10-year rule. To achieve 95% confidence that a manager's performance is not due to luck, we need enough observations. With a 50% win rate, the standard error of the win rate is 0.5 divided by the square root of the number of years. To get a confidence interval that excludes 50%, we need about 10 years. This is a rough calculation, but it illustrates the point. So, when you see a 10-bagger fund manager, what should you think? Based on the base rates, there is about a 97% chance that their performance is due to luck, and only a 3% chance of true skill. This is not a precise number, but it is a useful heuristic. It tells you to be skeptical and to allocate your trust accordingly. What does this mean for you? First, be skeptical of short-term track records. Second, understand that past performance is not a reliable indicator of future results. Third, consider low-cost index funds, which capture the market return without the risk of picking a lucky manager. Fourth, if you do choose an active manager, demand a long track record and a clear explanation of their edge. In conclusion, the genius fund manager is often a statistical illusion. We have seen how randomness can produce apparent stars, how academic studies confirm the rarity of true skill, and how long it takes to detect it. The next time you see a celebrated investor, remember the base rates: most are lucky, not skilled. Be skeptical, demand evidence, and consider the passive alternative. We would love to hear your perspective on skill versus luck in investing. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to Deep Quant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.